these investors in the UK, when they ask you, where are we currently in the investment cycle? How long will this story run for? How do you answer them?
I wouldn't say it's only the beginning, but I mean, we still have a lot to go. In the US, maybe they are a little bit earlier compared to the UK. So the story is a little bit different, but in the UK, the momentum is just starting. So it's very positive. We'll see the consumer doing better going forward. That will recreate actually the positive and the virtuous circle of good employment, good consumption, and investment. So I would say we still have a couple of years ahead to go.
And which are the key risks that your private clients need to be aware of?
I think surprisingly, one of the risks is that markets rise too fast and too high. We don't expect to have such good performances on market indices for 2014. We don't expect to see the S&P rising 30% again. We think it will be more on selectivity. So portfolio performance might be very good, but the index performance will be lower. So if again we see a very good momentum on the S&P, and if it goes too fast, we expect to see the volatility coming back and some bigger drawdown. It's been a long time we didn't see any pullback of, let's say, 10% on any big indices. And I think it will happen, and it may happen in 2014. And in this case, you just need to be confident in your investment and, of course, do not panic.
And with these potential drawdowns, is it time for perhaps clients to examine the possibility of guaranteed or structured products once more?
Well, structured products remains part of our investments, and we do use them. Going forward, as interest rates may rise, especially the long-term interest rates, there might actually be some very good opportunities to create such solutions.
So, and just to summarize, what are the final points that the investors need to keep in their minds? We talked about the policy, the US government policy. You've talked about the risks, and you've talked about the various economic scenarios. With an overall view, it's really keeping an eye on the US rates. I mean, is that really what it boils down to?
It is, but it is also to make sure that your portfolio doesn't have much interest rate risk. So do not buy very long-term bonds, even if they yield a little bit more than short-term bonds, and try to get some income using other asset classes. This would be definitely our advice.
So very much diversification, diversification, diversification.
Exactly, and maybe new mean of diversification, because as I mentioned before, the government bonds do not decorrelate anymore, to the equity market. So you need to find new asset class. I mentioned the hybrid bonds and the financials. I mentioned the infrastructures, also vehicles. There are many actually new ways to get income in the markets, and we can help our clients to identify them.
Eric Verleyen, thank you very much.
Thank you very much, Yuri.